Hello and welcome to Pro Trader Strategies Market Commentary for Wednesday, October the 25th. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. Having all that out of the way, we've got a lot of good economic data finally coming out today across the pond and here in the United States. But let's start with across the pond. We got preliminary GDP out of Great Britain came in at 0.4%, expected to be 0.3%. And let me preface, when I mean good economic data, I meant solid economic data, the stuff that is widely looked at, one of the leading indicators, if you will. And, having said that, they are looking like they are all coming out better than what was expected as well. Then here in the United States, we got core durable goods orders came in at 0.7%, expected to be 0.5%. And then they revised last month's number from 0.2% up to 0.5%. So good on both fronts. Even the revision was tuned up nicely. Durable goods, this one includes automobiles and airplanes, was up 2.2%, expected to be up 1%, so much better than expected on that front. And then the revision from last month was from 1.1% up to 2%. So both the revision and the current number coming out much better than expected. Now, a caveat to that durable goods orders, I'm sure that was skewed by a lot of the automobile purchases done after the hurricanes. A lot of those automobiles were destroyed, so people going out there and buying new vehicles probably accounts for a great number of that. Because remember, the core durable goods strips out those more volatile aspects of it, where the durable goods orders is going to add that back in. So, and then here also in the United States, we got new home sales coming in at 667,000 units, expected to be 555,000 units. So we're seeing a trend up in that. Existing home sales is better, as well as new home sales. Then we have crude oil. Crude oil inventories came in at a build of 0.9 million barrels, so 900,000 barrels. Expected to be a drawdown, though, of 2.6 million barrels. What does that mean? That should cause downward pressure, which is what we are seeing reflected in the crude oil here. As you can see, it is down 50 cents right now, basically giving up all of yesterday's gain. That value area high really acting as a resistance, more so than I wanted to see, because I was, if you guys remember, I'm long an XOP call spread, and in order to get that XOP, which is the oil and gas exploration ETF, I need to see some more upward momentum in crude oil, but it looks like we are kind of going to stay in this trend right here and fill in this little gap here, this low volume node that I've been talking so much about, starting to build that in, just kind of like I expected. But I expected oil and gas, once we got up into this 52 area, the exploration would kind of pick up and some of those guys would start picking up steam. But it is a lagger in a sense that that XOP has a tendency to trail crude oil a little bit more than I'd like to see right now. Then on to gold futures. Gold futures are pushing slightly higher today. It's really kind of a flight to safety. We got below that Fibonacci level. Now we're back above it again. Value area, the point of control has moved up. Remember, point of control was down here. Now it has moved right lockstep with that 61 fib level. Unfortunately, for the gold bulls and bears, I think that it's going to kind of lock in here. I thought we were going to go down there and test this Fibonacci level, but the equities are kind of not helping out the bearish assumption I had for gold. I was expecting gold to go down to 1250 with the pullback we're seeing across broader markets in the equities. Don't think that's necessarily going to happen. Well, the bonds making a big comeback off the lows of the day, down about a half a point right now. They were down over a point earlier today. The Fed, with this good economic data, would expect to increase interest rates going forward. That I've been talking about, I think, is on the docket, and with this economic data, we're starting to see that's probably a for sure thing, that interest rates are going to increase, despite the fact that we may see a pullback in equities. But it's kind of a flight to safety right now. We've got those two counter opposing things going on, where equities come off, flight to quality into bonds, gold, things of that nature, and good economic data today. Kind of those two opposing two opposing kind of ideas. Good economic data, bonds should go down, but pullback in equities causes bonds to go up. So those two guys are really fighting it out right now in the bonds. So bonds don't really have a whole lot of room to move. Now, this is the VIX back up into the 13 handle. Woohoo! It's kind of more normalized, to be quite honest, to be up in somewhere around the 13 to 15 area in historical terms. But anytime we get an increase in volatility, especially during earnings, that's good in my eyes, because that even pumps up those implied volatility percents even more. So we're starting to see that across the board in the equities as well. So that's good for earnings trades. Gives us the opportunity to get a little further away from where the underlying's trading. And because volatility is a fear indicator, that fear is usually overstated. So we're going to be able to take advantage of that moving forward, hopefully. But VIX up quite a bit today, almost 2 full points from yesterday, and this is why we're seeing the Dow Jones Industrial Average give back all of yesterday's gain, and basically the full week's gain at this point, but down 171 points on the day after yesterday's historical high settlement. A lot of people were talking about it was going to be hitting the 24,000 sometime this week. We're seeing that bit of a pullback today. I think we could easily see a bit more of a pullback, and maybe even come down and test this value area over the next couple of months. So I think we're going to see a little bit of a pullback here that I've been kind of waiting for in the overall equities. If we look at the NASDAQ, we can see it's down over 50 points, almost 60 at this point. It was down 60 at one point today. And looking maybe even to test that 6,000 mark that a lot of people were saying that we were solidly in. I talked about this, that it may very well want to come down and test the point of control, which is where the most time and volume has been spent. It's more of a technical move here, not necessarily what's going on in the economy too. So and that's healthy for the markets to have these pullbacks, because if you have the slight pullbacks every now and again over the course of a rally, you don't get the dramatic snapback that we see sometimes in the markets. We're like basically in here, where you start seeing this long rally and you see the massive snapbacks and then the rally and the massive snapback. We'd rather see a steady kind of comeback and then continuation of the rally. That's more healthy, if you will. E-mini S&Ps down 24 points also, and looking to, I believe, come down and test the value area high. That should act as support. It kind of lines up where it was acting as resistance here. I think we'll come back down in the next few weeks and at least test that before resuming to the upside, just because there's so many people out there talking right now. They're bullish the equities, because we're seeing the global economies kind of pick up. We're seeing the U.S. markets pick up. One thing, there's a saying that the markets will hurt the most amount of people as often as it can. So it's something along those lines. Don't quote me on that. That's not an exact quote, but it's something along those lines. But as we can see, the E-mini S&P is just slightly off of the lows of the day. This market has been unabated to the downside basically since the open, and we have gotten that economic data today that should act as support, but it's just kind of sloughed that off, and we're seeing a dramatic sell-off in the overall equities. All right, so with that sell-off coming with the overall equities, I didn't want to mess around with this Adobe trade. We got out of the balance of this trade. If you remember, I had on a long long put spread, and basically just blasted off when it got upgraded. I decided to leave on my short calls in there, my short puts in there. And the reason why is because there was still a lot of value left in those short puts, and I was trying to make up for some of the loss in that put spread. I was able to do that. Basically got out of the rest of it, and they were the December. I was short the 145 puts in there from the balance of that legging out of that put spread, and got out for 59 cents. So I made up some of the loss, not enough to really make up all that loss. Would have liked to kept that on for a little bit, but if the markets are going to pull back, I think Adobe might look to try and cover this gap here. So I just decided to get out of it. And those are so long duration, the D's, that 51 days, I'm not going to see a whole lot of theta decay happening for another basically 2 weeks. Didn't want to mess around with that if we start to see a pullback, and could easily have been testing those puts sometime in the near future. So I just decided to get out of it and move on with my life. And get rid of some of those long deltas in my portfolio. All right, so if you're following me on Twitter, this is one of the earnings trades that I did for Texas Instruments, which is ticker symbol TXN. And with that being said, I only did the Texas Instruments in my margin account. I tweeted this out that I was doing this trade, and I went into the weeklies, the October weeklies, and I sold the 92 puts for 35 cents, and I bought them back for 9 cents. So you can see I was directionally wrong with Texas Instruments right off the open. It did make a bit of a move to the upside, but has now since gone down and are near the lows of the day with the overall market slumping off. So it's really important to cover these trades almost immediately on the open. As a matter of fact, I covered this at 7:10 this morning. I put in a bid as it was rallying and was able to get out of that Texas Instruments trade there. And then in my, let's see what the next chart is, just to make sure I'm on this. Visa, ticker symbol V, came out with better than expected earnings. I kind of, just the way that MasterCard's been kind of moving against me. I also have a trade in there. That moving higher had a better than expected earnings. I had gone in there and sold some puts in there, and I sold the October weeklies again. Sold the 105 puts for 43 cents. Was able to get out for 5 cents. Now in my IRA, I did it as a put spread, kind of like in line with the rules that I come up with for an IRA or a synthetic naked short put spread. And I did the October, sold again the 105 puts in there, and then bought the 100 puts for a nickel. So I got out of that trade, got out of only the puts for, I sold that whole thing for 38 cents, and then I just got out of the 105 puts for 5 cents for a nickel. So I still have on that long 100 puts just in case anything crazy happens. There's no sense in really taking off that trade for 1 penny in my eyes. It's already kind of decayed out on those, and I might as well just leave them off, leave them on, not take them off, because then I'm going to have to pay commissions to take them off. I might as well just write it into the sunset, and if something bizarre happens, then I have that free protection, in a sense, is the way I'm kind of looking at it. But having said that, with way Visa started reacting this morning, was rallying off, I decided to take off my MasterCard trade that I had on as a long put spread. I was looking for MasterCard to have a bit of a correction. Kind of did, in a sense that it started coming back off, but at the end of the day, I put that on quite a while ago on like 9.13. I was looking for it to come back down. You can see that it rallied up, and it's starting to come off now. I had a couple opportunities to take it, but I was looking for it to cover this gap, which never happened. And I had on the November, I was long the 145 puts and then short the 135 puts, and paid a debit of $4.52 in there. I got out for $2.01. So usually with a defined risk strategy, I just kind of leave it on, but this obviously was before the overall equities really started tanking, and with the Visa coming out with better than expected earnings, I thought that this was going to move higher as well, which it did off the bat, but since the overall markets are coming down, that has since gone the other way. The other thing, I could have tried to take advantage of the earnings and ride that out, but I just decided if Visa came out with better than expected earnings, MasterCard was probably likely to do the same, and therefore I wanted to pull the ripcord on it. All right, so on to a few things that I'm going to be looking at today. I'm going to be looking at AMGN for a earnings trade, probably going to be playing AMGN to the downside. The other one is Las Vegas Sands. That's after the close today. I'm going to probably be playing this one to the upside, and then American Airlines we've got coming out. Going to play this to the downside, but I'm going to flip the coin. It's going to be a game day decision late in the afternoon whether I'm going to be selling American Airlines or Southwest Airlines, LUV ticker symbol. All right, there's also Hershey's, which I'm thinking about playing to the upside. I've never traded Hershey's, to be quite honest. Options are actually pretty in line with some of my rules, so I'm going to be taking a look at that as well. Potash, I'm going to stay away from. Morningstar, it's one that everybody's heard of, but they have terrible options, so I'm going to be staying away from that. And Ford, I'm not going to be playing around with that. It's just too small of a stock value for me to trade any options around. It's just too much risk for that. All right, so that's all I got for you guys today. Follow me on Twitter. You can find out what those earnings trades are going to be. I'll be just blasting out if I'm selling puts or things of that nature. Watch the earnings webinars to find out that exact location. I'm going to be following my rules on that. And Friday's webinar, we're going to be doing it on the long put calendar. So after these earnings are done, it's a great strategy to set up for the next earnings. Take advantage of some expansion and volatility. All right, so follow me on Twitter to find out the earnings and watch those webinars. If you can't take that, take it easy.